Hi there, welcome back to Markets at Noon. Let's get into conversation with Christy Mathai, Fund Manager Equity at Quantum AMC. And Christy, hi, good afternoon. Thanks so much for taking the time out and joining us on the show. First up, give us a sense of how you are positioning your portfolio amid all the geopolitical uncertainty we are seeing right now. How much of it is deployed? How much are you sitting in terms of cash?
Yeah, hi. Thanks for having me. So clearly, at this backdrop, the economic backdrop is pretty conducive compared to what it was, let's say, about 3 or 6 months back. What we have seen is the government is really pushing the pedal on growth, and we have some indication of it as we look at the 4Q GDP numbers as well. Also, the inflation is clearly moderating, and we don't think the current geopolitical issues would really change that materially, unless the crude were to go really up, which we don't foresee in a normal case scenario. And against this backdrop, what you've seen is RBI is infusing liquidity and front-loaded quite a bit of interest rate cuts. So this should propel some sort of earnings growth going ahead. The CRR cut of 100 basis points was particularly positive. It has a multiplier impact on the economy because the lending sort of increases, assuming the bank do not park it in G-Secs and they start lending again. So combination of these factors, we are fairly positive on the EPS trajectory going ahead. And this environment is very good for the private capex, to grow as well because you have had interest rate cuts. The corporates can borrow cheaper. At present, they have significant cash on their books. But given the tariff uncertainty, especially with respect to Trump and so on and so forth, there is some issues on that front. But broadly, we think all the signs are right for the earnings growth to slowly pick up. Our concerns chiefly is on the valuations. Given the 10% or more rally that we have seen from in the past couple of months, valuation is the only concern for us, and hence possibly we are not looking at a great set of returns 1 year or 2 year out. But apart from that, broadly, earnings trajectory should be positive.
All right, but Christy, any new sector where you believe the earnings momentum can really take the sector higher from current levels? Because a lot of sector churning is already underway. We have seen the run up in financials. Other than that, off late it's the IT select healthcare counters that are making a comeback.
Right. So in terms of earnings, possibly where there could be things can look up from our sense is purely looking at the IT pack. They just, I know we've had possibly very near-term rally, so it's to say in IT. But what we are looking at is most of the FY26 numbers have been dramatically cut. It's possibly in the vicinity of maybe 3 to 5% growth, which possibly the managements are guiding. But we think this number, at least maybe FY26, 27 could be much better, owing to the fact that the technology spends possibly can come back because we are sitting over 3 years of absolutely no IT spends, especially on the services part, by the major banks in US or the manufacturing sector. So there is a possibility of that picking up. Plus, the margins also can expand given some of the cost levers that most of the IT players have in hand. So we think that could be a possible place where there could be earnings surprise as we move ahead. But broadly, if you were to just think about the consumption theme also, where we are invested through autos primarily, which is also a play on interest rate cut, and there could be better credit growth in that particular sector, which is at present not happening. So some of these two-wheeler volumes, especially in the mass segment, which have been hit by inflation for a long time, which is now moderating, can be a surprise going ahead.
While we're talking about consumption, let's talk about an ancillary that's cement in a way. Give us a sense on where you're seeing cement as a sector moving ahead, because we've seen benign raw material prices now. Government capex has spruced up as well. But on the other hand, you have the monsoon overhang, so that seasonality is coming into play. Where do you see the cement sector headed now?
Right. So we are invested in cement sector as a whole through one of the company which is more contained to a specific geographic location. where the price hike in the recent past have been good. But see, over the course of the year, you will have a usual seasonality play out. Typically monsoon season, you will see some demand moderation, which sort of picks up as you go ahead in the month of October or towards the Diwali. So that's the usual seasonality. The issue was last year was, one of a kind because you've had significant demand moderation along with fierce competitiveness because a lot of new players large players who have sort of consolidated, were pushing up the volumes in through some of their acquired entities. So that was what was depressing the prices, to a 4-year or 5-year low. Now we see that improving, which is sort of a big positive for the sector as a whole. Monsoon seasonality is nothing out of, it usually happens. So there is nothing concerning as such. And the government capex and slowly the demand recovery in, let's say, the housing segment should be a key driver as as you look at the cement stocks.
All right, but Christy, we did touch upon select sectors there, and also you did share your outlook on the earnings front. But if I have to ask you top 3 sectors where you are most bullish on, which one those will be, and the 3 sectors you believe will be languishing for some time from now to participate in the rally for Indian markets?
Right. So clearly the, where we are large allocation are clearly the banks, financials, which is not very different from when you look at an index perspective. But the point is here, we think, until now, if you were to look at the whole people visualizing the rate cut cycle, they were expecting an extended rate cut cycle. But with the stance change and the commentary that you hear, looks like there will not be further rate cuts. So what you will have is a 1 or 2, maybe 3-quarter impact on NIMs. But CRR cut is sort of positive. So that's on the extreme near term in terms of what will happen. But otherwise, we think the credit growth should normalize ahead. It is at paltry 9%, sub 9% at the moment, and the deposit challenges are slowly going away. So you should see that credit growth pick up as you go through the year, possibly in the second half. So 12-13% is what we think the long-term credit growth has been for a very long period of time. We do not see that change. And within that, the private players would have their play with slightly higher growth rates. So that remains a pocket which is very attractive to us and reasonably valued in our view. The other sector, as I said, was IT and some bit in consumption, which is especially the auto pack, with primarily play on two-wheelers. So that's broadly our sort of sectors where we are reasonably positive on. We have picked up on some of the financial plays as well, something like an insurance, which we have added in the recent past. That also looks pretty attractive on you when you were to really think about long-term, growth, because there is significant protection gap as we see it in the life insurance space, and the valuations are not so expensive. The pocket where we are not so convinced about is, again, this is primarily driven by valuations. You just look at some of the, cap good names, some of the names which are driven by order book, especially dependent on how the, government spend would be. Those are the pockets where there could be room for disappointment going ahead in our sense. And some of the capital market linked themes, where there could be MTN impact in one of these years. We could not really pinpoint which year it would be. So these would be places where would be a little bit wary of, but by and large positive.
Okay, Christy, thanks so much for joining us. On that note, we'll let you go. But
if you like this video, then like, share and subscribe to ET Now.